All right, let's do another update. It's July 10th, 2024. It's 10:48 p.m. We'll start with the dollar. Here's a chart of the dollar versus dollar relative sentiment. Dollar relative sentiment is still bearish, but as you can see, it's at 47%, which 50% is the demarcation between bullish and bearish. So it's right on the precipice of turning bullish. Last week it got marginally more bearish, but it still really didn't go anywhere. So it could easily turn bullish this week, which would likely have repercussions for risk assets. So we'll have to keep an eye on that. We'll find out on Friday whether it did turn bullish or not, or whether it will turn bullish next week. If we look at the dollar chart, so dollar relative sentiment turned bearish here in February. The dollar has basically chopped around since without any real directional initiative. Every time the dollar has sold off, the broader market has been able to rally. Every time it's risen, the broader market has had trouble rallying. So in June, the S&P was up big, the NASDAQ was up big, but the Russell 2000 was down, the equal weighted S&P was down, most sectors were down. So it was really just the mega cap tech that did well in June, and it was most likely explained by the fact that the dollar was rising, financial conditions were getting marginally tighter, and that wasn't good for stocks. The broader market, we also had a growth slowdown, but in the last week or so, the dollar has started to sell off again, and we might have seen the Russell and the equal weighted S&P in some sectors start to drift a little bit higher. Not by much. They were probably kind of held back by the fact that investors probably want to see what the CPI comes in tomorrow before really jumping into to the broader market. So tomorrow will be a big event, and we'll see if that is a catalyst for the rest of the market to rally. Here's commodities. This is oil. So big picture, commodities are in a secular bull market, multi-year low whenever oil went negative here in April of 2020. It's been much higher since, but we look like we're in a cup and handle. So the expectation would be for oil to move higher in the years to come. Whether that happens in the near term or not in an election year remains to be seen. Now, of course, with the intra-party fighting with the Democrats, where a lot of people don't want Biden to be the nominee, one way to force him out would be to have the equity market sell off, or oil to rise, or gasoline prices to rise, for the inflation print to be hotter than expected, just to manufacture some outrage, some more pressure to cause him to step aside. So if that intra-party conflict were not there, I would expect that oil would probably have some headwinds until at least the election. But given that that conflict is there, maybe we do see oil rise in the near term. Now, if you look at relative sentiment in commodities, it's bullish at the moment. It's bullish so long as dollar relative sentiment stays bearish. As long as dollar relative sentiment stays bearish, the positioning landscape is favorable for commodities. But if it turns bullish next week, then all bets are off with respect to commodities. Here we have TLT versus composite TLT relative sentiment. It turned bearish last week, so it's below 50%. It just went below 50% after several weeks of being above 50%. So we might see interest rates rise from here. I know that a lot of the bond gurus that I follow on Twitter, they're of the same mind that the 10-year yield will likely rise to 5% by the end of the year. We're halfway through the year, so that rise might start soon. And now that the positioning landscape is not favorable for long duration bonds, now might be the time that we see interest rates move higher. If we look at a chart of TLT, this red line corresponds roughly to, when TLT is at that line, the 30-year yield is roughly about 4.45%. So the 30-year yield has had a hard time staying below 4.45%, as TLT has had a hard time staying above this red line. That makes sense. Why would you invest for 30 years at 4.45% when the 10-year is giving you almost that much, when the 2 years giving you more than that much, and when T-bills are giving you 5.25%? So the negative term premium, the bond gurus don't think it makes sense. And so, we might see interest rates start to rise from here, especially because the positioning landscape isn't quite favorable for long duration bonds at the moment. And if you look at this chart, it's been a pretty good indicator of when to be bullish and when to be bearish. When it's been bearish, the red lines have generally gone down. When it's been bullish, the green lines have generally gone up. So now that it's bearish again, we might see TLT fall, interest rates rise. Here's gold, composite versus composite gold relative sentiment. Composite gold relative sentiment turned bearish in mid-June, but gold's held up relatively well. It's gone slightly higher since composite gold relative sentiment has turned bearish. But each week in that time, institutions have continued to sell gold and silver relative to retail traders. So their individual relative sentiments are getting more bearish when you throw in the dollar and euro relative sentiment with gold and silver relative sentiment to get a composite gold relative sentiment. That, as you can see, is at a pretty low level here with the spot positioning, and the smooth version of that the composite gold relative sentiment is also moving well below 50%. So we'll see if gold can still hold up. If we look at a chart of gold, as time moves on, it's actually converging with this trend line, and the 200-day moving average is also moving higher. So maybe it doesn't have to have a big sell-off to kind of reset sentiment, to take out some of the froth. Notably, China didn't buy any more gold. Their central bank didn't buy any gold in May, didn't buy any gold in June, but India did buy a bunch of gold in June. So possibly that's why we're seeing gold have some support. We are in a secular bear market driven by high inflation. Gold will probably be one of the best performing assets. So we shouldn't be surprised if it does have support even when gold relative sentiment is bearish, just because of the macro secular forces will likely keep gold elevated during this time. If we look back here one more time, from basically all of 2023, from actually probably 10 months of 2023, gold relative sentiment was bearish, and gold essentially went sideways over that time. So it didn't really have a huge sell-off or anything when gold relative sentiment was bearish. So maybe we'll see something similar this time. And in this case, it actually went higher whenever gold relative sentiment was bearish. That was right before it turned bullish, and it continued higher. If we look at silver, silver's also held up pretty well. So composite silver relative sentiment turned bullish here, turned bearish here, but it's up, I think, 5% since it turned bearish. Whether that can sustain remains to be seen, but again, secular forces, the fact that they've held up well is a testament to the fact that these assets are likely going to be the best performers in the years to come. If we look at equities, this is the NASDAQ 100. It's the NASDAQ 100 index, it's not the futures. If we look at the Fibonacci retracement from the all-time high in 2021, the previous all-time high, to the low in 2022 in October, and we do this Fibonacci extension, today it hit the 1.618 Fibonacci extension, which is a pretty prominent technical level whenever there are no more levels above to act as resistance. So the market's never been this high, so there aren't any resistance levels that have formed in the past where you could say, okay, when you get to that level, it'll probably pause because it paused previously at that level. Well, it's never been to this level before. So where would a natural place of resistance be? Well, it would probably be a prominent technical level like this Fibonacci extension. And it hit that the day right before the CPI report. So that's why it's, wouldn't be crazy if the markets took a little bit of a breather here, given they're at this prominent technical level and we have a big economic report released tomorrow. And the market's just been going up the last several weeks relentlessly. At some point you would think it would pull back a little bit just to kind of reset the sentiment. S&P 500 did the exact same thing. It didn't quite hit its Fibonacci extension, which was at 5,638, and it closed at 5,633. I don't think it hit that level. Maybe it did, and maybe it closed a little bit off that level, but you can see it's virtually there if it didn't hit it today. So again, right before the CPI report, the S&P hits a big technical level. Again, it would be a natural place for it to take a breather and pull back. When it comes to valuations, The Warren Buffett indicator, market cap to GDP, is at an all-time high, way higher than it was in 2000 and 2007. And yet, the equity market is chugging along like everything is completely normal. If you look at our preferred indicator, valuation indicator, it's basically at the third highest level other than the dot-com bubble and the everything bubble. But given that we're up this week, and if we hold the gains so far through Wednesday, this 0.519 will probably be 0.511 next week. I think if we rise another 5% from here, maybe it's only 4% now because the S&P was up 1% today, we'll hit this 0.518 level. And if we rise 10% from here within a reasonable time frame, within the next few months, we will likely reach the dot-com bubble level. So we are at fairly extreme levels. These aren't levels at which secular bull markets start. I know a lot of people believe that we're in a secular bull market and that we're just getting started. I think we're nearing an end. So we'll have to see, how that evolves. But when the market, the NASDAQ was up 50% last year. It's headed towards, it's up 20% so far this year. If it continues to rise, it's not usually the case that you have huge return after huge return after huge return. So a third year of huge gains would probably be unlikely given the gains that we've seen so far. The reason we like the AIAE is because it has a lot of correlation with future returns. Of the dozen or so publicly available valuation indicators, it has the strongest correlation with forward returns. Up until recently, the most it had ever diverged from the actual forward return was on the order of 400 percentage points on an annualized basis. Now that's a lot when you look out over 10 years, but all the other indicators have diverged by much more than that. But since 2021, when the liquidity floodgates opened, this has diverged by more than 400 or more 4 percentage points. Did I say 400 percentage points? 400 basis points. 4 percentage points was the most it had ever diverged. But right now, it looks like it's around 6 to 7 percentage points higher than what this forecast was. So we're massively above where 10 years ago we would have predicted the market to be. A lot of that, I think, is due to the liquidity. A lot of that is due to the AI bubble. A lot of that is due to the fact that the U.S. fiscal situation desperately needs asset prices to rise in order to get capital gains taxes, to lower the deficit so that the bond market doesn't blow up with increased treasury supply. So it's basically become a policy tool. I don't think they can keep those plates spinning forever, and I think that this blue line will eventually reconnect with this black line, potentially move through it. So we could be getting near a point where there's an inflection. And if you look at the expected equity risk premium, we're at a level that has only ever been seen before during the dot-com bubble. Notably, the first time that the expected equity risk premium hit minus 3.8%, which is currently, it was in April of 1999, and the top wasn't until March of 2000, so it was 11 months away. I don't think we have 11 months left in this bull market. I think the election will probably be something where that could be a stopping point, and potentially even before the election. Another 11 months of what we've seen would take us, way beyond any, reasonable valuation levels. And, given the lackluster performance of AI so far, and the fact that more and more prominent people are saying that, it's a bubble and that it won't live up to the expectations, and the models that they're building don't have the ability, the native ability to do, what people are expecting AI to do. So there could be a lot of wasted investment, and that could wipe out a lot of value in a hurry once that becomes widely known. Here's a chart of the S&P versus the Federal Reserve, reserves at the Federal Reserve. A lot of people think that there's a connection between these two. I know some thoughtful people have looked at it and say there really isn't a connection. And as you can see of late, there hasn't been a connection. The S&P has been going higher. The Fed balance sheet has been going lower. So whether this will reconnect or not, in the near term, we'll have to see, but this is sort of an argument that these two really aren't as connected as people like to believe. Speaking of bubble, here's NVIDIA. You can see that it's essentially, dwarfed the gains of Cisco, Intel, Microsoft, and Oracle, the 5 years leading up to the top of the dot-com bubble. NVIDIA's, almost doubled their return. And if we look at it, NVIDIA is still tracking on the three peaks in the domed house. However, a couple weeks back, we did a little video and we showed that there was a phantom tick in NVIDIA at 195.95, which is 50% higher from here. I wouldn't rule out the possibility that NVIDIA could go that high. It would become a $5 trillion company at that point. Maybe it has a blowout earnings in late August when it reports. Every time it's reported recently, a 50% jump wouldn't be totally out of the question. The jumps seem to be getting larger as we go along. That's sort of indicative of the mania that we're seeing. That might be the top if it actually does reach that level, but if that's the case, then this head and shoulders is going to be a lot higher than where it currently is. If we go back to March 2000, the S&P strongly outperformed the equal-weighted S&P, and we're now seeing that same type of outperformance by the market cap weighted versus the equal weighted S&P. So it's at a pretty extreme level. If we look on the shorter term chart, here we had extreme outperformance by the S&P versus the equal weighted S&P, but we had a bearish divergence on the momentum. Again, here we see very extreme outperformance since 2023, and again we're seeing a bearish divergence on the momentum. So here they're saying that a reversion is coming and it will shake things up. I would tend to agree that there will be a reversion, but we'll get to the but in a second. Just to kind of continue in the same vein, the 3-month correlation between the S&P 500 and the number of advancing stocks is the lowest on record. So again, we're seeing things that are outside the historical distribution. So it is a really fascinating time to be observing the market. We're seeing things we've never seen before. So it's, if you have curiosity about the market, what else are we going to see that we haven't seen before? We're seeing the most fragility event in the last 30 years, where a fragility event is a 3 sigma daily move in one of the 50 largest stocks. That's probably not good long term. That will probably have some negative repercussions at some point. Here's the S&P 500 versus the equal weighted S&P 500. This is just to show that its distance from the current price to the 200-day moving average is and the 99th percentile. It's above the 99th percentile actually. There's only been 2 times in the history of these two ETFs, which I think the equal weighted goes back to the early 2000s. So it's not, a 50-year look back, it's about a 20-year look back. But in that time, there have only been 2 times where the distance between here and the price was more than 8.66%. However, if we look at a monthly chart of the S&P 500 versus the equal weighted S&P 500. If you go back to 2015, there's this phantom tick here in that ratio at 4.17. It's currently at 3.4, so that's more than a 20% return to get to that level. So we might just be getting started in terms of how extreme and how silly and how manic the market is going to get. Since May 31st, if you go back to May 31st, it's almost 6 weeks ago. It was a Friday. The S&P was selling off. The NASDAQ was selling off. They were down, over 1%, maybe even close to 2% in the middle of the day. And they just turned on a dime and they rallied the rest of the day until the close. And the S&P might have actually finished higher on the day. If not, it finished flat. The NASDAQ was down slightly. But ever since that day, that was a sort of a foreshadowing of the fact that there was relentless demand for these indices, and they've essentially been higher almost every day since. And every day I wake up and I'm like, okay, well, it's got to sell off today. In the morning it does sell off, but by the close it's way higher. So every time the thing sells off, boom, it's, switch is flipped and it just starts to rally again. And as that starts to build, as more and more people expect a pullback, to thwart those people and to confound them, it has to go higher, and it probably has to go higher at a faster clip to kind of, keep that people off balance, in which case maybe we do hit this phantom tick that's 20% away. I would not dismiss the possibility that that could happen. But if it does, there's going to be a rug pull like no other in the history of markets. It'll be something to see. Here's the Russell 2000. So while the S&P and the NASDAQ have been going higher, the Russell has been moving sideways for almost 6 weeks. It's in this falling, broadening wedge, and those are supposedly bullish patterns. Every time it's hit the top trend line, it's gotten beaten back. This big green candle here, where it basically touched the trend line and then got beaten back, was the last CPI report. So the CPI came out, it was favorable. Russell jumped up 3%. It was more than 200 basis points ahead of the NASDAQ on the day of the CPI report pre-market. So it was outperforming by over 200 basis points pre-market. But as soon as the market opened, it just started selling off the entire day. And it was up over 3%, and it finished up like maybe 1.5% or something like that, maybe even less. The NASDAQ, on the other hand, opened up and it just rallied the rest of the day. And then the next day, the Russell fell, almost wiping out its gain from the CPI, and the NASDAQ rose again. And then the Russell fell again, and the NASDAQ rose again. And so like the 3-day outperformance of the NASDAQ versus the Russell was enormous after the last CPI. But just as the NASDAQ and the S&P closed at their Fibonacci extension levels, very prominent technical levels for the S&P and the NASDAQ, the Russell closed right on this trend line, this broadening trend line, the broadening wedge trend line. So something big is going to happen tomorrow. It's either going to break this trend line and move higher, or it's going to move lower. Something I wouldn't be surprised to see is if it moved lower first and then moved higher from there. And the reason I say that is because the Russell has a phantom tick down around 2010. It closed at 2070, so that would be a 3% move lower if it were to hit that phantom tick. But it has a bunch of phantom ticks higher, even ones near the old all-time high around 2400. So I expect it to eventually head higher, but it does have a fairly close, phantom tick down around 2010 that it wouldn't surprise me if it hit that and it looks like it's breaking down, but for it to be a false breakdown and for it then to turn on a dime and rip higher and go take out the phantom ticks above. We'll see. Maybe that maybe it just heads higher, takes them out above, and then we have a bear market and it eventually gets down to this one near 2000. But that'll be something I'm looking for tomorrow. It's a reaction to the CPI report, because something is likely going to happen. It's probably going to have to bust out of this sideways range here. It's either going to go higher or it's going to go lower. Speaking of phantom ticks, so this is the ratio of QQQ to IWM. So 1 minute chart, it's from today. So pre-market, both QQQ and IWM had their own individual phantom ticks, which meant that the ratio itself had phantom ticks. And we had one down here at 246.57, and we had one up here at 248.18. And so the market opens, and it goes down, it hits that phantom tick at the low end, it bounces immediately, but then it goes back down, it violates it, but it can't sustain, and then it trades in this range, and then it goes up and it touches that phantom tick, and it comes back and it touches again in the late afternoon, and then it sells off. So this phantom tick basically confined the range, as did this phantom tick. Now, whenever this phantom tick printed, QQQ and IWM were at their own respective levels at 8 a.m. Whenever the ratio hit that phantom tick again, they were at different levels. They weren't at the same levels, but the ratio, calculated or computed to that level. How the market knows where and when, to stop relative to these levels, it's, mind-boggling, but, I do think that there is something to those phantom ticks, just seeing how they get hit and seeing how the market responds to them, especially on a ratio chart where, it shouldn't have anything to do with what the ratio does. But here, why did it stop here? Why did it come back and stop there again when it could have gone higher or stopped well below that? I'll never know. But that's why I wouldn't dismiss the phantom tick in NVIDIA. I showed you a few weeks ago in January of 2022, this S&P 500 had a phantom tick down where it bottomed in October, 10 months later. So it basically foreshadowed where the low was going to be. So yeah, I wouldn't rule out the fact that the equal weighted S&P could potentially go to that high level that we saw, the phantom tick from 2016, which would be a 20% rise in that ratio. So to close out, we see that the presidential nominee prediction markets have Joe Biden. He fell 15% today, so he was above 50%. He was at 60%. That's not quite 60% because these don't add up to 100, but he was above 50% to be the nominee. Today he's below 50% to be the nominee. And because of that intra-party fighting, that could have repercussions for the CPI. So we saw this tweet today. It kind of matched with our intuition that if there's the donors want him out, the New York Times wants him out, George Clooney wants him out. If that's the case, then you might start seeing potentially bad inflation numbers. You might start seeing oil rise. In fact, the last two crude oil inventories were huge draws. So last week there was a 12 million barrel draw. This week there was a 3.5 million barrel draw. Much worse than expected. They were expecting builds, and then you got draws in the inventory. So that might put some upward pressure on oil, on gasoline. Maybe they manufacture a little equity sell-off to put some pressure on Biden. But those are the things that I'm kind of looking at to see if they play out. But to summarize, the equity markets are relentless. They're at important technical levels. We have a big economic report tomorrow, so how the market reacts from there could set the tone for the next few days or a few weeks. We're still, we are still several months out from the election. So normally I would say we probably haven't topped yet, and we still are in a bullish seasonality, seasonal period that's pretty bullish. But again, if you have this inter-party fighting with the Dems, that could have repercussions for the market as a means of trying to force Biden to leave the race. So we'll see what happens. But that's all I have. Thanks for joining. If you have any questions or comments, leave them in the chat, and I appreciate it. Thank you.